Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. There's been a pause here since late June from the definitive break lower from the second, flatter, but also lopsided larger January to mid-June diamond pattern. It's the one that's highlighted in bright red on my daily chart. We now have overhead the following supports have become resistances. The 2016 high at 179.55. The influential neckline currently at 177.05 of the January 2020 to April 2021 reverse head and shoulders bottom. And the congestion, quite a lot of congestion in fact, between 174 even to 174.5, containing the August 2021 low at 174.5 and a 50% Fibonacci line of the May 2019 to February 2022 move at 174 even. We also have the declining short medium moving average, currently 171.5, the medium 176.75, and the long currently 173.60 moving averages. Prices moved down through a fairly free area all the way down to punch right down through the 2017 high at 159.30 and finally reach the primary target in the 156.35 zone for the lopsided diamond pattern before stabilizing. We still have the secondary hard to reach target X1 down in the 141.80 zone, though it is looking increasingly distant right now. Okay, so there are two further ingredients to throw into the mix. As of 7 Thursdays ago, we had a bow tie formation of the median, short and long moving averages together. They originally seemed to be in no order nor indicate any direction, but they did cross over and subsequently headed lower. The theory behind this indicated a potential move between the 6th and the 13th of July. Well, we had some strange activity on the 6th, but nothing that indicated the future direction. However, what we have seen over the mid-July to date action is the partial formation of one of possibly two patterns. I say partial because we are still forming within the market the first of these, and they are a possible small descending scallop pattern or a possible small rounded bottom. Now there is also a possible third pattern of a sideways triangle, but it's not that strong a pattern idea, not right now. Personally, the small descending scallop pattern looks like a better idea right now, but it's a toss-up of a coin as to which it will be. This requires close attention to what will be happening here over the next week or so. Meanwhile, just also keep an eye on the next supports below. The Fibonacci congestion in the 153.60 to 153.30 area, then the August 2017 high at 147.25, and finally the congestion between 143.35 to 142.45, just above target X1 containing the 2019 high at 142.95 and the September 2017 high at 143.35. London coffee. Okay, so we saw the market 5 weeks ago punch down through and close below the lower time, currently at 26.91 of the major January to March bullish Andrews pitchfork. Now I've still kept this on my daily chart, not highlighted. For one more week I've kept it, as it's been running the market high in, to be honest, a pretty perfect pattern since roughly mid-March until late June. Since then, prices have tried a little higher through the June 2011 high at 26.41 and even just under the March 2011 high at 26.72, but they weren't able to stabilize over either, as last week saw a changeover gap, which is 24.93 to 26.17, that pushed down through the core of July support. And that's the important short medium moving average, currently at 25.96. The changeover pushdown dropped prices below support at 25.18, 24.68, the rising medium moving average, currently at 24.53, where they started to stabilize just above the support at 24.11 and the target also at 24.11. That's the primary target for this pattern. I mentioned that last time. And something also I've mentioned last time is that this might be forming a bump and run reversal top. We have come awfully close to reaching target X, and I'm still watching carefully for that level. However, we also have the much harder, potential secondary target X1 for this pattern below around the highs of late February and early March at about the lesser Fibonacci line at 2203. Now, I fully expect to make some further potentially drastic finessing on these in the coming weeks, but for now these will do. This brings me to a controversial point, and one I apply that others might not. You see, I use continuous charts, as you see in my technical analysis, and there are heaps of arguments on what you should do when you have changeover. I'm constant in what I do. I ignore the change and apply it as part of the market's action, even when it might seemingly not be accurate. This leads to the controversial action I have on my daily chart for last week of a weekly key reversal down made up from two separate actions. Some might not agree, but that is how I deal with this action, with this overall action. Furthermore, the action also lends itself to being a possible bear flag, the late June to date action. This is a huge question mark. There is one, a huge question mark over this idea, so please treat it accordingly. For your information, I haven't marked any target below, but it would be in the 2400 zone if I had done so.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.